Fund Supermart, your online gateway to unit trusts.
What is your outlook for global equity in 2016, and what are some of the opportunities that you see for global equity?
Okay, KC, for the past 8 years, the world asset markets have had the tailwind of US Federal Reserve printing money at the rate of 85 billion US dollars a month. That's quite a tailwind, and that money, although it was meant to be to get the US economy going, has found its way all over the world. We've now got Japan, the European Central Bank following suit, but the prime mover, the United States, stopped doing that on the 22nd of December last year. So we have a major change in wind direction, and they turn more into headwinds. I think this might be a year in which we encounter some of the unintended consequences of the ending of quantitative easing in the United States. That could lead for a bumpy ride. I think that developed markets have got a little bit overexcited about the way things are going to go, but emerging markets and Asia-Pacific emerging markets, and even some of the larger markets like India in Asia look very good value at the moment, and they have adjusted their prices a lot better than the developed world.
What are the likely catalysts as well as key risks that investors should be aware of?
Okay, I think there are many catalysts all over the world, one of which is the Chinese authorities losing control of their currency, losing control of their economy. They've had a few wobbles with their currency, and the handling of the collapse in the renminbi, or the heavy fall in the renminbi, hasn't instilled confidence, but they still have a lot of strings to pull. I think China still has control of its economy, and although growth might be 6% or maybe even below, that's still quite healthy. So that's one problem that the markets could panic about. Another one is that Janet Yellen, the US Federal Reserve, changed direction, and that turnaround in interest rates actually leads to markets freezing or maybe going into free fall, and they decided, as they have done 3 times before, to stop raising interest rates, and in fact to start to pump money into the economy again. So we have QE4. Will QE4 work? I don't know. I think people might think that this massive experiment with printing money doesn't work, and then we might be in for another serious hiccup. That's another catalyst. Other catalysts, I think, maybe are a bounce in commodity prices. They've been falling for 4 years consecutively, and people still need to eat food. People still need to manufacture products. But I think particularly with regards to the edible commodities, prices have adjusted too far, and so there's an opportunity there. And then the other sort of fastballs are things like Europe falling apart, like North Korea dropping bombs, like Donald Trump getting elected as president and picking a fight with Putin. These are scary things that could affect markets.
We have underweight the developed markets in 2016, but continue to advocate an allocation in this market for portfolio diversification purposes, with the expectation that 2016 should be another year of positive earning growth for developed market companies. Does Aberdeen share the same view?
I don't think we're as positive on the United States, and I think that the earnings per share that have been coming out of the United States are largely a function of share buybacks and dividend payouts. If you take away share buybacks and dividend payouts from earnings per share in the United States and the S&P 500, those two factors are larger than the earnings of S&P companies. They turned down last year. In fact, S&P 500 earnings per share were down 15% year on year in September 2015, and I think that's after margins have gone to a maximum. I think from now on, maybe people won't want more money to work. A lot of their costs are going to go up. Basic wages are going to rise. I think maybe the US is as good as it can get. I would still invest some money in the United States for diversification purposes, but it is not a market I'm that excited about. Europe has some great companies that have huge exposure to the area where we're most excited, which is emerging markets. So Europe we quite like, and I think there will be earnings growth, but that earnings growth is from companies listed in Europe that get their earnings from emerging markets. But I think that emerging markets globally look more attractive. The emerging markets in Asia Pacific have been hit very hard, both assets and currencies. And there is an opportunity to buy those companies that are well managed. Use a fund manager that spends its time visiting these companies and has a very clear picture of what their value is, and that can pick them up when the shares are trading at below that value.
The US valuation has becoming quite expensive over the past few years. Is US still a viable option for investors to invest in, and why?
Well, if you look at the MSCI World Index, which measures all equity markets in the world, the weight of the US in that is just shy of 50%. That is a huge weighting. It would be dangerous to have zero in the US, but I think it would be wise to buy those companies that are A, of a quality, and B, of a value that you think are right. And there aren't many like that in the United States. Aberdeen Asset Management is significantly underweight the US markets, and that has been a problem for 2015 because earnings and the markets themselves perform very well despite earnings falling. But I don't think we're going to change our system of bottom-up investment, picking the right companies at the right price, and therefore we'd be underweight the US. Europe, we're slightly overweight. Japan, we're slightly overweight. But our major overweight, I think, is in global emerging markets.
How should investors position their portfolio in 2016?
I think I mentioned before there are some potential consequences of 8 years of this money printing, unexpected and unwanted consequences, some of them geopolitical events. So I personally, and I'm not really speaking for Aberdeen here, would have 10% of my money in gold. Gold is an insurance policy against the madness of the world. But other than that, I think that you have to use a conservative fund manager that even in volatile markets like emerging markets and developed markets buys those companies that they're very familiar with and they really understand, and that have good governance and have transparency and understand what minority shareholders are at the right price, which is what Aberdeen does.